Welcome back to Talk Tickers, the professional earnings call summarization show for the experienced investor.
We really dig into the numbers so you don't have to. It's good to be back.
Today is Friday, January 23rd, 2026, and we're focusing on just one company, the absolute roller coaster that is Intel Corporation, ticker INTC.
Oh, it was a wild ride. They dropped their Q4 2025 earnings, and the market reaction was, well, brutal.
Brutal is one word for it. The stock was down, between 6, maybe 13% in after hours?
Yeah, depending on when you looked. And this was after a huge run-up. I mean, INTC was up something like 40% going into the print.
Exactly. So the stage was set, expectations were high, and then pop. The balloon just deflates.
But here's what's so interesting. This isn't your typical demand story. It's not, oh, nobody wants our stuff anymore.
No, it's the complete opposite. The narrative has totally flipped. It is 100% about execution now.
That's it. Intel is basically shouting that they are supply constrained. They have the demand, especially in AI, but they can't make the chips fast enough.
So let's break this down. It's a classic good news, bad news story. Let's start with the good news, the backward-looking numbers. Q4 2025, how did they do?
You know, looking in the rearview mirror, Q4 was actually a solid beat.
Right.
Revenue came in at $13.7 billion. That was ahead of the street's $13.4 billion.
Okay.
And non-GAAP EPS was 15 cents.
Yeah.
I mean, that's almost double the 8 cents people were looking for.
And what about margins?
Gross margin, 37.9%, came in 140 basis points ahead of their own guidance. So on paper, a pretty good quarter.
Okay, so if you just read that headline, you'd be thinking, great, why is the stock collapsing? But, the market is a forward-looking machine.
Always.
And the guidance for Q1 2026, honestly, I had to read it twice.
It was a shocker.
Yeah.
First, the revenue guide. They're looking for $11.7 to $12.7 billion.
So the midpoint, 12.2, is already below the street.
Well below. But that wasn't the real,
Uh-huh.
the real kick in the teeth. It was the EPS guide.
Zero.
Zero.
I mean, literally $0.00. A goose egg.
Non-GAAP EPS expected to be $0. And the street was looking for 5 cents. On top of that, gross margin guide just falls off a cliff to around 34.5%.
That is just a brutal reset. So let's get into the why. How does a company that owns its own factories run into a supply problem?
Well, this is what we're calling the supply paradox.
Yeah.
The CEO, Liputan, he was very direct about it.
Sounded almost apologetic.
He said he's disappointed they can't meet demand. And the CFO, David Zinsner, he flat out called Q1 the trough for supply.
But help me understand the mechanics. They own the fabs. Why can't they just, add a night shift or something?
It's not that simple. It's really a physics and a time problem. It takes, 3 to 4 months for a single wafer to get through the entire manufacturing process?
So the decisions they made last fall are what's hitting the shelves today.
Precisely. And they admitted they just misread the demand signal.
They didn't see the AI wave coming for their CPUs. I thought it was all about GPUs.
That was the old thinking. What they missed was the step function change in demand for x86 CPUs in the data center. You need those CPUs to host the AI accelerators. Plus, you have a big server refresh cycle happening.
They looked up and said, uh-oh, we need a lot more server chips.
Right. And they started to shift that wafer mix back in Q3 of 25. But because of that lag time, those server wafers, they don't actually come out of the fab until late Q1.
So right now, they're living hand to mouth.
That's the exact phrase. Their buffer inventory is gone. They sold everything they had, and now they're just waiting for the next batch to finish.
Okay, that explains the trough. But there's also the roadmap. We've heard about 5 no's in 4 years for ages. What's the status on the big one, Intel 18A?
So 18A is real. It is shipping. It's not a PowerPoint slide anymore. Yeah. The first products are out, the Core Ultra Series 3, which is Panther Lake.
Shipping is good, but are they making money on it? Because that's a whole different story.
And that is the catch. Ken was surprisingly candid. He said yields are improving, maybe 7 to 8% a month. But in his words, they're still below what I want.
Which is CEO speak for, we are losing money on every one of these we sell right now.
Exactly. When your yields are low, your cost per chip is sky high. And that is a huge part of why that Q1 gross margin guide is so awful. They're ramping a new node, and the defect density is just not where it needs to be yet.
So a drag on the P&L. Okay, what about the next generation? Intel 14A, the big foundry play.
We got a really interesting update there. They said 2 potential customers are evaluating the tech. They've sent out the version 0.5 PDK.
The process design kit?
Yeah, so customers can start designing test chips.
But no contracts, no firm commitment?
No, not yet. And this is the new Intel. They made it very clear. No major CapEx spending on 14A factories until they have firm signed volume commitments.
Show me the money, then I'll pour the concrete.
That's the new mantra. And they expect to have that clarity, one way or another, by the second half of this year, 2026.
And speaking of CapEx, the whole strategy for 26 is changing, right?
It is. Total spending is flat to maybe slightly down, but the mix is what tells the story.
Less on buildings.
Way less on shells, as they call them, and a heavy pivot toward tools.
So the actual machines that make the chips.
Exactly. The lithography, the etchers, they need to increase wafer starts on Intel 7, 3, and 18A like yesterday to fix this bottleneck. It's about filling the space they have, not building new space.
Okay, let's slice this by segment. Data center and AI, or DCAI. How did that unit look?
DCAI is fundamentally the star of the show. Revenue was $4.7 billion. That's up 15% sequentially.
And I'm guessing it would have been higher if they had supply.
Management said meaningfully higher. It's that paradox again. They're leaving money on the table because they can't produce enough.
So what's happening on the product side there?
They're all in on Diamond Rapids. And they're accelerating Copper Rapids, which is interesting because they're bringing back multi-threading.
Oh, that's a big deal. Why is that so important?
It's all about performance density. The hyperscalers, your Googles, your Amazons, they want that. It lets one core do two things at once. Intel had moved away from it, but now they're listening to their biggest customers again.
So if data centers getting all the priority wafers, who's getting squeezed?
That would be the client computing group, CCG, laptops, desktops.
Let me guess. Numbers were down.
Revenue was $8.2 billion, down 7% year over year.
Is that just a bad PC market?
Not really. It's internal cannibalization. Intel is choosing to give its limited wafers to the high-margin data center chips first.
So CCG gets what's left over?
Or they outsource it. They're using external foundries more and more to fill those gaps.
Okay, what about the foundry services business itself?
So revenue was $4.5 billion, up 4% year over year. The bright spot there is the EUV mix.
Extreme ultraviolet, the new tech.
Right. It went from less than 1% of their wafers in 2023 to over 10% in 2025. So they are making that transition.
Right.
But the losses are staggering.
How?
A $2.5 billion operating loss in the quarter. It actually got worse because of those early 18A ramp costs.
So for an investor, this all paints a pretty messy picture in the short term. That 34.5% gross margin.
They admitted it's not acceptable. Their target is to get back above 40%. But there are other headwinds too.
Like what?
Memory prices. DRAM and NAND are getting tight. Prices are going up. And that directly hits the bill of materials for their client chips, which hurts their margins even more.
I did see one little bright spot in all of this, though. The ASIC business.
Yeah, the custom silicon unit. That hit a $1 billion annualized run rate.
That's not insignificant.
No, it's a huge deal. It shows they're not just fighting the trend of hyperscalers making their own chips. They're joining it. They're helping them do it.
Yeah.
If they can execute there, it's a massive new business.
So let's tie it all together before our favorite segment. The overall tone for management was cautious.
Very cautious. They see the AI wave hitting them, but their hands are tied by manufacturing until at least Q2. They're basically pleading with investors, just give us 6 months to fix the plumbing.
Fix the plumbing. I like that. Okay, so beaten down stock, a trough quarter coming up. This brings us to the fun part.
Time for the big disclaimer.
You know it. This is not financial advice. We are not your advisors. This is purely for entertainment. Do your own research.
Don't sue us.
Please. Okay, so the setup is the market hates the near term. But there's this potential binary event in the second half of the year with the 14A customer news. What's the trade?
I'm calling this one the Foundry Flipper calendar spread.
Ooh, catchy. Explain it.
All right, so the thesis is simple. Maximum pessimism is priced in right now for Q1. Everyone hates the zero profit guide, but management just gave us a date to circle on the calendar. 2H 2026 for 14A news.
Survive in the spring, thrive in the fall.
You got it. So step one, you sell the current fear, sell puts, or to define your risk, a bull put spread for, say, April 26.
So you're collecting premium, betting the stock doesn't fall off another cliff from here.
Right. You're betting the trough is the trough. The bad news is out. You collect that cash from the high volatility.
And step two, what do you do with that premium?
You take that premium and you use it to go long. You buy aggressive, out-of-the-money LEPS calls for January 2027.
A long-term lottery ticket.
Exactly. You're positioning for the announcement pop. Imagine it's September and Lip Bhutan gets on a call and says, we've signed a major customer for 14A. The repricing of the stock will be violent.
So you're essentially getting paid to wait through the bad news while holding a ticket for the potential good news later.
It's an asymmetric bet. If they fix the yields by summer and land a customer, you're positioned perfectly. If they don't, well, your near-term spread might still expire worthless if the stock just goes sideways.
The foundry flipper. I love it. It's risky, it's aggressive, but it perfectly fits the story they told.
It's creating their own timeline.
All right, let's wrap this up. Quick recap.
Q4 was a beat, but Q1 was a massive miss on guidance. 0 EPS. It's all about supply constraints. 18A is shipping, but it's expensive, hurting margins. 14A is the big prize for later this year.
And the final thought to leave everyone with.
This turnaround is no longer about a plan on a slide deck. It is a physical challenge. It's about getting physical wafers out of a fab cleanly and quickly. The clock is now officially ticking on that Q2 recovery.
High-stakes manufacturing. Doesn't get much better than this. Thanks for listening to Talk Tickers.
We'll see you at the next print.
Talk soon.